Investing. Goals. Before you start investing, you need to consider what is your goal. You need to think of a measurable goal and then make a plan. An example of this is, are you saving for a deposit on a house? Are you saving for retirement? Are you looking to purchase a new car? Each of these goals is different, and the approach for each would vary. Growth or income. When looking at where to invest, you need to consider whether you're after a growth-based investment or income, or a combination of both. There are essentially two types of investments. A growth-based investment is an investment that is expected to gain value over time. Examples include shares, property, or even a rare art. These investments may or may not pay a regular income, and the capital gains are realised when the investment is sold. It's important to note that as a general rule, there's no tax payable until you actually sell the investment. Income investments, on the other hand, pay you a regular income, and these would include term deposits, debentures. A tenant of a property you own may, for example, pay you rent, or a share which you own, such as the ANZ Bank, may pay you a dividend. And the income which you receive would be added to your tax. There are three basic places where you can invest. There's cash and fixed interest, property, or shares. Cash and fixed interest are referred to as stable asset classes. Examples of these include bank accounts, term deposits, and debentures. These type of investments usually pay you a regular income stream, which is fully taxable, and the capital value of the investment is usually stable. Property, on the other hand, includes such things as a vacant block of land, a residential house, a commercial property, a listed property trust, or even where you're a member of a property syndicate. The capital value of the property can go up or it can go down, and you may also receive rent whilst you own the investment. Shares, on the other hand, are where some businesses, for example they can be a public business such as the ANZ Bank or a private business, offer shares for sale that you can be a part owner in that business. When they make a profit, you're entitled to a share in this profit. The value of the investment can go up or it can go down depending on the profitability of the business. You may also receive a dividend whilst you own the investment. Now, you can hold these investments, either cash and fixed interest, property, or shares, either domestically in Australia or alternatively internationally. But it is important to note that each investment is different and each has its own advantages and disadvantages. What is suitable for one person may not be suitable for another person. Tread carefully where possible and seek advice. When you're looking to invest, it's important that you consider how long you'll actually be investing for, as this will affect how you actually invest. For example, when will you need to access your investments? Some investments lock your monies away for set periods. Are you investing for the short or the long term? An example of this is if you're putting money into superannuation. This might be good if you're saving for your retirement, but if you're looking to buy a new car, a high interest account would be better. Because if you'd put the money away for superannuation, you can't actually touch it until you retire. So it's very important that you actually consider the time frame for your investments. Another important factor to consider is what is your risk profile? In other words, how comfortable are you with investing? There are investments that are conservative and there are investments which are aggressive. Now you need to decide how much risk you're willing to take. Some of the factors which will impact that decision include how much experience you've had with investing, how long you're investing for, how much you're willing to lose, how comfortable are you with your money at risk, and what are you trying to achieve? Investing in accordance with your risk profile is very important, as what's good for one person is not necessarily good for another person. Everyone's different, everyone has different needs, objectives and circumstances. So this is a very specific decision to you. Another issue you need to consider is diversification. And the old adage of don't put all your eggs in one basket is what applies here. If you imagine, for example, you had one pencil in your hand and it broke, you'd have no pencils left. But if you have 20 pencils in your hand and one broke, you'd still have 19 pencils. So it's important that when you invest, you actually diversify to reduce what we call a stock-specific investment. When you invest in a number of different investments, you avoid the risk of very large losses. It's important you also consider what are the costs of an investment. Many people forget to ask what an investment actually costs. And it's important also to remember that any fee which you pay reduces your investment return. The fees could be an upfront fee, a commission, or even an annual fee. And remember, someone will be benefiting somewhere. There's no such thing as a free investment. Do your research and make sure you understand the costs of the investment. If you need more information, please don't hesitate to contact any of the websites shown on the screen. And good luck.